Freeze for a second, because moments like this don't knock twice. Silver didn't just drift higher, it snapped upward. And if you're telling yourself this is just another routine rally, you're watching the surface while something much bigger is shifting underneath. Before we go any further, quick reminder. We've got over 1,000 members who receive daily members-only videos and early access to every upload, so they stay ahead of market moves. If you want that same edge, consider joining. Click the link in the description or tap the join button below. It takes less than 30 seconds. Now listen closely. Today we're running a simple giveaway, 20 ounces of silver. To enter, like this video, subscribe to the channel, and leave a comment with either your favorite type of silver or your price prediction for this year. That's it. At the end of the month, we'll select a winner on a live stream and announce it on camera. But the giveaway isn't the real story. Here's the real issue. When silver prints triple-digit prices while everyday life still looks normal, that's not entertainment. That's a warning sign, because here's what feels unsettling. Groceries still scan, the stock market still acts bulletproof. Most people are still walking around like nothing has changed, and yet something clearly has. Based on recent market updates, silver is hovering around $115 an ounce after pushing even higher intraday. Gold is holding above $5,200. That's not a typo, that's a flare. So the question isn't whether silver went up. The question is why it moved before the obvious crisis showed up on the evening news. Hold on to that, because in a moment I'll share the one clue almost everyone is ignoring, the clue that determines whether this is a short-term spike or the opening scene of a completely different decade. Before we get there, check the description. You'll find bonus links, including a premium WhatsApp channel and the channel membership link. Premium members also get members-only videos produced by a separate research team. More structure, deeper research, more detail. Keep that in mind, because the next few months will reward preparation, not reaction. All right, let's talk about what just happened, without hype, without panic, and without the lazy to the moon nonsense. I spoke with a friend of mine, someone who works with real money mechanics, not just charts. The first thing I said was, "Tell me I'm not crazy. We're up big and I still feel uneasy." He laughed, but it wasn't a happy laugh. He said it feels like watching a storm roll in while everyone else is still setting up picnic chairs, because when silver goes vertical, it's not really silver winning, it's the dollar losing. That distinction matters. If silver hits 150 but your rent doubles, insurance triples, and your paycheck buys half as much, did you actually profit or did you just survive? That's why I keep saying, don't obsess over how many dollars your metals are worth. Focus on what your dollars are turning into. And right now, they're shrinking fast. According to publicly available filings and policy schedules, the central bank is stuck in a middle zone. Rates are high enough to squeeze, but not high enough to cleanse the system. Pressure builds, then cracks appear, and everyone acts surprised. We talked about what would make this feel like the real endgame. His answer was simple. You'll know when the next major rescue arrives. Not a quiet liquidity tweak, not a technical adjustment. I'm talking about rates being slammed back towards zero and fresh trillions forced into the system because the banking plumbing starts choking again. That's when the calm mask slips. Here's the cliffhanger. Silver just made a move that usually comes after that kind of rescue. So why is it happening before? That's the question that should keep you awake. Because if silver is front-running the bailout, it means the people closest to the pipes are seeing something the rest of the crowd hasn't noticed yet. No, that doesn't mean the world ends tomorrow, but it does mean the risk meter just climbed. Now I want to challenge something that gets repeated a lot in precious metal circles. You'll hear that paper metals won't matter, only physical counts, derivatives go to zero. Here's my take. In a true breakdown, counterparty risk becomes brutal. A promise only matters if the system can enforce it. But it's also true that markets can remain functional longer than expected, and paper exposure can still act as a bridge. I'm not here to preach a one-size-fits-all approach. I'm here to say, understand what you own, why you own it, and under what conditions it works. Physical metals are about sovereignty, something you can hold. Paper exposure is about liquidity and flexibility, until it isn't. The danger isn't owning an ETF. The danger is thinking an ETF is the same thing as metal in your hand. Those are different animals, and the faster prices move, the more that difference matters. Then my friend said something that hit hard. He said, "This is separating investors from exiters." Some people buy metals to grow an account balance. Others buy metals because they don't trust the measuring stick anymore. When the measuring stick bends, the second group stops caring about daily quotes. They start counting ounces like lifeboats. But even if you're in that camp, you still have to deal with volatility. Silver doesn't rise like stairs. It moves like an elevator with a broken cable. Up fast, down fast, then up again. We talked about corrections. A sharp pullback wouldn't shock me at all. It might be the most normal thing imaginable. What matters isn't whether a correction happens. It's what happens after. Some corrections are just a breath. Others are the last chance. And you only know which one it was once it's behind you. Now let's address what confused people today. Why are prices different depending on where you look? People kept messaging me saying the paper quote was here, but physical prices were higher elsewhere. So I asked him directly, is this a shortage? Is the market cracking? He explained it simply. There are multiple silver markets that only look like one when conditions are calm. Under stress, they separate. There's the retail coin market, there's the industrial market, and there's the futures and warehouse market. In calm times, they move together. In stress, they drift apart. Industrial buyers need refined metal of specific purity delivered on schedule. When supply tightens, they pay up because the cost of missing production is worse than paying a premium. That's how you get one price on a screen and another in the real world. And when those prices drift, it tells you the plumbing is under strain. Here's the key point. If that gap widens, it doesn't just affect silver. It affects everything priced in dollars because it proves that the quote isn't always reality. So are we in the endgame or a preview? My friend leaned toward preview. The public isn't panicking yet. No empty shelves, no daily repricing, no mass stampede into hard goods. So why is silver acting like it is? He said, if silver can do this while the public is asleep, imagine what happens when they wake up. That line matters. Now let's talk pullbacks. In fast moves, dollar shortages can force selling. Even people who believe in silver may sell to raise dollars, not because they change their mind, but because the system forces them to. That's how violent drops happen. Anyone telling you it only goes up from here is selling comfort, not truth. Here's the real truth. Nobody knows the exact top, bottom, or timing of policy pivots, but we can map the logic. A weaker currency environment increases the value of real assets and increases volatility on the path there. So stop treating metals like lottery tickets. Treat them like insurance. When I asked what a new person should do, his answer was boring and smart. Don't try to time perfection. Start small if needed, but don't stay empty-handed. Once you have a base position, stop obsessing, build your life, build income, check prices only when allocating new money. Obsession turns preparation into panic. If silver looks expensive, ask yourself, expensive relative to what? A high quote can be a symptom of a sick currency, not an overvalued metal. Gold above 5,200 and silver around 115 aren't normal Tuesdays. What makes this dangerous is how calm the public still is. The gold to silver ratio is compressing, meaning silver is outperforming. That can overshoot, snap back, or fake people out. Use ratios as thermometers, not prophecies. He told a story about buying silver in the 20s and watching it go nowhere for years. That's the part nobody likes to hear, patience. Preparation is boring until it suddenly looks genius. If you're here because silver is trending, fine. Just don't leave when it stops trending. That's usually when real positioning happens. Now let's bring this back to daily life. When metals scream higher, it reflects trust breaking down. And when trust breaks, behavior changes. People stop holding cash. They move into things that can't be printed. That shift drives the next leg. So answer this in the comments. Are we early or late? And if silver pulled back 30%, would you see it as a disaster or a gift? Silver is pulled by two engines: monetary fear and industrial demand. When both rev at once, prices snap. This isn't about hype alone. Hype doesn't create supply. It just lights the fuse faster. FOMO is how people buy short-term tops. Pause. Define your allocation. Define your timeline. If you can't answer those, you're gambling. Endgame isn't a date. It's a sequence. Crises patched over again and again until the patch stops working. Markets move before press conferences. Watch actions, not words. If you wait forever for the perfect pullback, doing nothing becomes your decision. Scale instead. Plan your position so you can sleep. Silver isn't exploding because silver changed. It's exploding because the trust environment did. Don't panic. Don't get intoxicated. Stay alert, stay humble, stay prepared. I'll see you in the next video. This content is for education and perspective only. I'm sharing how I think through fast-moving markets, not telling you what to buy or sell. Make decisions based on your own situation, risk tolerance, and professional advice if needed.